Hi everybody, little unofficial episode here. Honestly, it's Friday afternoon and I'm ready to get out of here. But I just finished a research project I was working on yesterday, and I wanted to share with you my findings real quick, because it's too much to read. So just let's look at this for a sec. It's all on my board, and I did a lot of writing, and there's a lot of proof and whatnot. Some of you probably have heard me talk about this infinite banking thing before. That it's a concept that I really believe in, and it's based on the book Becoming Your Own Banker by Nelson Nash, Unlocking the Infinite Banking Concept. And it's a very, very long and not easy process to learn. If you've come to my office, you may have gotten one of these, the Banking with Life DVD. I give this to almost everybody who talks to me about financial planning. But I wanted to show you guys, I made a chart after doing a lot of research and did a lot of like averaging and research compilation to figure out the different times in our lives that we have big major life events. Now you'll notice the wedding and the children thing is a little later than the national average. I did that specifically because I'm looking at someone who pursued a higher education, and sometimes that causes a little delay there. But for example, graduation, our first car, our wedding, when we finance our next car, statistically we buy a home at 33. These are charting the American spending habits through our lifetime. And I'm only looking at major purchases and major events such as like cars, weddings, home purchases, kids' college education, retirement dates, and life expectancy. So what I did was I took a 30-year-old who makes $45,000 a year, and I made a scenario where they purchase a new mid-range vehicle at ages 39, 45, 53, and 60 at 5.1% financing for 60 months. As you can see, that corresponds perfectly with the chart, and the chart was based off of about 5 or 6 sources I found. So I made a model, and it was really comprehensive and took me about a week to finish. But what you're seeing here is a comparison between 3 major types of saving and spending habits. And the 2 on the left, the middle and the left, are the 2 most common ways that people save and invest. And the one on the right is this infinite banking concept that I keep talking about. And I talk about it a lot because I really genuinely feel like it's the cure for financial cancer. And I mean that in every sense of the word. Let me give you the brief rundown. And I included proof of each methodology along with my study. And hopefully I'll be able to publish this in a way that's easy to read. But for example, I made that 30-year-old save $3,600 a year to a Roth-style 401k with a 50% match up to 3% of salary. I gave him a 7% compounding rate of return, no downside. After fees and administration, he nets about 4.5%. Okay, and that's actually a national average. That's not something I just made up. Now, he's putting in $126,000 a year. He's getting, $126,000 over the 35 years. He's getting a match of that much over the 35 years. So that's how much is going into the account. By age 65, he's looking at $229,000 after all is said and done with no death benefit. Now, the second person doesn't have a 401k. So he saves $3,600 a year into a brokerage account. But instead of financing his major purchases, like the 401k person, he's going to pay cash for his major purchases. And when I say major purchases, I'm talking, the cars, the down payments on the house, the colleges, the weddings, etc. Those are major purchases. And they're going to save $3,600 a year into a brokerage account. They're going to use cash to pay for it, but they're going to replenish the money to earn more interest over the long run, that same 4.5%. So this person is going to treat it like a loan. They're not just going to take money out of their account and not put it back. They're going to play honest banker with themselves and say, hey, I've got this money, but I want it to continue earning even though I'm going to use it from time to time. So I'm going to put it back. Total, and this is considering all the car purchases, right? He's going to pay a total of $126,000 into the account with interest of $11,272. So That's what they've put in at the end of the 35 years. By age 65 in this model, they have a tax-free dollars of $251,864, no death benefit. And I've got the proof for both scenarios. Now, the infinite banking concept. The infinite banking concept is actually using a specially designed, maxed out whole life insurance policy for not only death protection, that's not why we do this, it's to take advantage of the tax-free growth, tax-free distribution, and overall consistency of this kind of account. The interest that it earns, the flexibility, the fact that you can go get the money whenever you want without penalty and it'll still earn interest even though you're using it. I put the same $3,600 a year as the others, except this person's going to put it into an infinite banking policy, uses the money as collateral, and pays cash for their big purchases. They'll make payments back to the policy and treat it like a loan, just like the cash person and just like the 401k person, because they're financing loans on their cars. These other two are self-financing loans on their cars. So infinite banking for major banking functions excluding checking, you notice the same amount is going into the account as the brokerage account guy. But at age 65, the infinite banking person has $303,000 tax-free and a permanent death benefit of $549,000, even though that wasn't the point at all. And I've included the proof of all three. So this is what most of us are doing, if you didn't know. You're doing a 401k, you're getting a match, and you're financing things because you don't have money available. It's all locked away in your 401k. That's just the reality. And the reason that the 401k account loses out is because, well, the 401k is growing tax deferred with a match, but financing, that's the key. This person is financing the 4 cars. They're paying principal and interest, and they never get to reap the benefits of compound interest, and they give up money to finance charges forever. So if we look at the chart here, which is one of the proof statistics I made, the actual amount in the 401k at the end, you can't really see that, but let me see if I can zoom in. It's $322,000 after tax available in the account. However, keep in mind that this person financed their 4 vehicles outside of the account. So we have to factor in principal and interest, and they're left at the end of the day with $229,000. The other 2 individuals actually used their growth accounts, the brokerage or the infinite banking policy, and got the money out of there that they're already saving anyway, used it to make their purchase, and both people replenished the money, treated it just like any other loan. The finance person, the cash person, and the infinite banking person, under the assumptions I laid out, are all paying the exact same payment, so to speak, to the method of saving, and also the same exact payment, so to speak, to the car. So even though there's a match over here, and we don't have a match in the other 2 methodologies, the 401k loses out every time because we've put the banking function in the hands of the finance company. And in the other 2 cases, we've taken the banking function away. We've maintained control of the money. And between the 2, it's a pretty clear winner. Now this is a 30-year-old, and I'm doing the 40-year-old model right now, and it's coming out pretty much the same. So that'll kind of hopefully help some of you understand what this infinite banking stuff I keep talking about is. If you want to know more about the research project, ask me about it. I'm going to try to package it in a very easy to digest way, and I'll probably do another video on it. But for now, I wanted to share before I got out of the office for the week. And yeah, I hope you enjoyed it. I hope it shed some light on things. So bottom line, I guess what I'm saying is if you're saving into a 401k, even if you're getting a match, just by the fact that you're financing most of your major life purchases, you're giving up any kind of meaningful gains you made in the 401k because you're growing over here, but you're paying on the other hand. It's counterintuitive. Now the one in the middle, they're growing, but they're also losing out on the interest they could have earned because they're using the money in the policy, or excuse me, in the account. The third person, is taking a collateral loan against the cash available in their policy, but the whole amount is still earning interest the entire time. Plus there's a permanent death benefit. The numbers check out undeniably. So if you're in that position on the left, where you're contributing to the 401k and you're financing everything, you may want to rethink that. I know you probably have never had anybody tell you this, and this concept is probably very different than what you're used to hearing, but I've been studying this for about 3 years now, and I know what I'm talking about. So if you have any questions about this infinite banking stuff, don't be afraid to call me and ask. Glad to answer questions, and I hope this at least sheds some light on one or two things. So have a good weekend. Bye.